stageanalysis.net. This is the regular market breadth update I like to do. It's been a few weeks since my last update, and a lot's happened in those last couple of weeks, and we'll run through that in a little bit. Please subscribe to the videos if you like them, and please remember to click the like button to help YouTube recommend us. Okay, let's start this week with a look at what's been going on in the major US markets. So in the last few weeks, we've seen, since my last video, we saw another thrust down, and then we've had this week, we've seen some bullish engulfing candles on the weekly charts, which signals a sign of a near-term low at least. So obviously we've had a very strong bounce off the lows this week, and basically we closed the week above the open of the previous week on the S&P 500, the Dow, the Nasdaq, but the small caps didn't quite have the same. They didn't get a bullish engulfing candle on theirs, as it was a much smaller bounce, but still significant with a 10% bounce. They all had 10 to 12% bounces themselves. The Nasdaq only an 8.5% bounce there, but obviously a strong look on the candle there. So all are deeply oversold after 5 or 6 weeks of straight selling due to obviously what's been going on in the world. And so obviously everyone would expect some kind of strong bounce, as during bear markets we generally get obviously exceptional brief rallies. So where it will end, we do not know. It may have already ended, but it may continue up to retest some levels. So where could it get to? Looking at the charts, obviously if technical analysis comes back into play, then we've obviously now got resistance on the S&P 500 back up here in these levels, 2,800 to 3,000 range here. There's a lot of significant resistance there. Obviously, normally with technical bounces, you'll get maybe a 50% move back up to here. So again, similar sort of range. We move down from there, so you should see somewhere up here when we meet with a declining 30-week moving average at the time, or maybe a declining 10-week moving average here. The Dow, similar looking chart to the S&P 500. Obviously looks a bit more extreme there. It's been underperforming the S&P 500 for most of the year, but this week, in this week's bounce, you saw it had a stronger move than the S&P. The Nasdaq, on the other hand, had a weaker move, and that has been outperforming for a very long time. And obviously, its move was strong, but it hasn't fallen as far as the other indexes. So obviously, you would expect its bounce to be lower. Its moving average 30-week moving average here is flattening out. So if we only get a 50% bounce or so, we should see it sort of get back to the 30-week moving average level here. The small caps, on the other hand, like we said, the bounce has been weaker. So where they will go, we're not sure. But it's got some significant resistance of obviously the entire 2019 range, which was a stage 1 developing range at the time, and obviously we've moved back into stage 4 with these recent obviously sell-offs. So anything up to that level would give us some significant resistance if you got back up to there, but obviously that would be a huge move if it did. So we'll see where we go. Next we've got the percentage of stocks above the 150-day moving average charts that I do for all the major individual sectors. So this is after such a large sell-off. You can imagine this is gonna stay down in the lower levels for a while, because obviously most of the major sector charts and stocks are a long way below their 150-day moving average, which is a proxy for the 30-week moving average. So as you can see from the previous charts that we just looked at with the S&P 500 and the Dow, etc., like we are way below the 30-week moving average. So individual stock charts can be even further. So as they've sold off, a lot of stocks have sold off exceptionally hard. So you can imagine it's going to take quite a while for these to recover. So at the moment, best performing sectors are healthcare, consumer staples, and technology. Obviously, the Nasdaq composite itself, because actually it's made up of mostly these sectors. The NYSE is made up of more things like financials and industrials and basic materials, etc. Obviously, as you can see, these are all in the lower range, the 0 to 10% range. If we look at the actual percentages, you can see that obviously healthcare is almost back to 20%. It's at 19.29%. Had a strong week with a 6.57% move. Technology also had a strong week, as did basic materials, moving up 5.41%. It actually had no stocks last week above their 150-day moving average, and we saw some recovery this week with the basic materials, as gold had a very strong week itself, and so which pulled up some of the mining stocks. As you can see, the majority of sectors are below the 10% level, so it's, as we said, it's going to take a while for this to recover. Next, we've got the Treasuries charts on the left here. So this is the 7 to 10 year Treasury chart. As you can see, we're still in a strong stage 2 range. The volatility of the last few weeks has disappeared in the last week, and it had a modest 1.54% gain is approaching new highs once more. Gold, on the other hand, had been declining for the last few weeks and has got below its 30-week moving average and had moved into stage 3A. We had a very, very strong bounce this week with an 11.42% move, and it pushed back towards the highs again, closing slightly below and consolidating a little bit on the daily charts, starting to make a little bullish handle there on the daily charts. So this has got potential for a stage 2 continuation attempt once more, but at the moment it remains in potentially an early stage 3 range until that happens. Next, we've got oil down the bottom here on the bottom left. This had another continuation lower this week with another lower close, smaller move of only 5%. Say only 5% on a normal week. That would be quite a big move, but obviously in recent times that was a bit more modest, although it did have a pop up and fall back during the week. Copper similarly fell down and then pulled back up again. It did actually close the week slightly higher, 0.02%, so basically at neutral, but above where it opened on the week. So it did have a slight bullish tone, but it's in stage 4, as is oil, and quite far below their declining 30-week moving averages now. So there's a long way back for both of them. Next, we've got the Bullish percent index and the percentage of stocks above their various moving averages. At the top, we have the 200-day moving average. The next is the 150-day moving average, and the bottom is the 50-day moving average. So the left is the NYSE chart, and the right is the Nasdaq composite chart. So on the Bullish percent index, we had a very, very strong move on the week, basically moving up from just above 10% there to over 50% in a single week. I actually don't think I've ever seen a single bullish week like that. I'll have to look back through the historical charts, but that's actually the biggest move I've seen ever on the Bullish percent index. It's normally quite sedate, as you can see from the last few years. It has some strong weekly moves, but the last month or so, it's some of the wildest swings I've ever seen on it. So, but normally with this, the move back above 30% is a signal line, although we're using the line charts here. So how the Bullish percent index signals are generated is via point and figure. So, and when you get a move back above the 30% level from below, it went from the lower zone, it's considered a bull alert signal. You don't get the bull confirm signal until you get the double top breakout on the P&F chart. So we would need to get a pullback and then a break above wherever the high is from this. So we will see when that comes. For at the moment, like the NYSE Bullish percent index moves to bull alert, as does the Nasdaq Bullish percent index, with just over 50% of stocks back on a P&F buy signal. And what we got here, so 46% in the Nasdaq back on a P&F buy signal. On the percentage of stocks above their 200-day moving average, this is still lingering down in the lows, as we saw in the sector breadth, with only 34% of stocks above their 200-day moving average, only 5% above their 150-day, and only 4.7% above their 50-day down here. Again, the signals are the same on this. We look for moves back above the key 30% level here, but again, we want to see you only get a bull alert signal when we get that. We want to look for a double top breakout, so we need to make a swing high either below the 30% level and then break above it, or wherever the swing high is made. But basically the signal on these charts is once you get that double top breakout and it moves back above that 30% level, so we'll be watching out for that. But with stocks so far below their various moving averages at the moment, after such strong selling for multiple weeks, it could take many months in order to get signals on the medium and long term charts. Although the 50-day moving average chart should catch up quicker, and you always see a move back above the 30% level on that first, as you can see, like in previous times where back in 2018 here you got the move back up here before. Yeah, and then the double top breakout here, whereas the 50-day and the 200-day, the 150-day and the 200-day take a little bit longer, because obviously they're slower to move, and it takes more time for stocks to get back above those levels. Next, so look at the advanced decline line charts. This is the NYSE advanced decline line charts. I've broken them up into 4 different types. So we have just the cumulative advanced decline line on the left up here, which has had a move up this week and slight pullback at the end of the week, but it is below a declining 50-day moving average. The momentum index down the bottom here, so we have the 10-day moving average momentum index and the 200-day moving average momentum index. Like with these, we had a signal in the last week of a first bullish breakout signal here, where it broke above a little consolidation pattern near the lows here, and it's pulled back up towards the 0 level. So we've had a short-term buy signal on the momentum index at least. Obviously, the cumulative is on a bear signal still. The 200-day moving average momentum index remains in a downtrend here, so also on a bear signal. The NYSE McClellan oscillator, again similar to the 10-day momentum index, works very similarly. Had a buy signal here. The summation index has made a small low and pulling up a little bit, but remains on bear signal down there at the moment, as does the 10 and 30-day moving average, the exponential moving averages of the cumulative advanced decline line. The signal on that would be a crossover of the 10-day and the 30-day. So at the moment, as you can see, they're still a bit apart, although they're starting to pull back together, but they remain on bear signal currently. Next, we've got the US new highs and new lows. We've finally seen some pullback towards the 0 line on this. It's after a strong amount of new lows. On the cumulative chart here, this is a 5-day cumulative chart, and on the right we have the full cumulative, which actually is a cumulative line. As you can see, it's extremely oversold below its 50-day moving average here. On the combined chart here, you can see, obviously, we normally look for signals with a divergence here. So once you get either a breadth thrust back above the 0 line and then pull back, and then obviously a much higher low on the next set of lows, when the market is still obviously making new lows, that would be start to give you some signs that there was some bullish momentum. But obviously at the moment, we're just seeing a decline in the amount of new lows. We haven't seen any pickup in new highs, with obviously them down at obviously microscopic levels over the last month versus the new lows. But the new lows have calmed down a little bit over the last week, as you would expect. Okay, the next is my cumulative point and figure breakouts minus breakdown charts that I do. I do the every day I track the point and figure double top breakouts and the double bottom breakdowns, and I chart them. And so on the left here is the cumulative chart. This obviously had a bounce this week, but it remains below a declining 20-day moving average, which I use for my signals on this one. So I'd be looking for the cumulative line to move back above 20-day moving average here for some kind of signal that risk was lowering. As you can see on the daily chart here, where if you have the net breakouts minus breakdowns, we've had a lot of volatility obviously in the last few weeks, like obviously vastly out of the normal range. But we did have a thrust this week with a surge of new highs, so signaling a short-term bottom. So whether that becomes a more sustained bottom, only time will tell, but there's obviously a good sign to see that we've had obviously a strong amount of breakouts there, which is played out in the 10-day moving average chart here. As you can see, the amount of new lows, breakdowns is obviously pulled up, and we're getting back close to the zero line again, whereas the 50-day has only had a minor pull up. Okay, I think that's us back at the end. So it's been a hectic few weeks, month or so in the market. I think we're starting to see the first signs, first nibblings that the obviously market is making a low. Obviously we made a low this week. Whether it holds, we don't know. But obviously the market breadth charts are showing a few little green shoots, but not many at the moment. So we could well be in for a rocky ride for many months to come yet. And obviously whether this becomes a longer stage 4 decline is obviously unknown, but we'll continue to monitor the breadth and obviously decide when it's time to get back in. But at the moment the weight of evidence remains on a bearish signal with obviously short-term positives, so we could well be in for a brief rally for multiple weeks, but obviously we will see. Obviously nothing's guaranteed, and there's been no strong bullish signals for long-term investors as yet. So until next time, I'll see you at stageanalysis.net, and thanks for watching.